Welcome to this month's market update. I'm joined today by Chris Trevelyan, Director of Investment Strategy here at Frontier Advisors. Hi, Chris.
Hi there, Wayne.
Now, official GDP data for Australia has just been released, and that has confirmed that Australia is officially in a recession now.
Yes, the first recession in Australia since 1991. It's the end of the world record for the longest economic expansion in the developed markets. In many respects, though, this is old news. This is data for the 30th of June quarter, and it confirms effectively what we already knew. This was the period of the heightened COVID restrictions, and so that saw GDP fall by around 7%. There was a very large fall in consumption. There was a big spike up in the savings rate. So although there was a lot of fiscal stimulus from the government, which helped dampen the contraction, consumers were not able to spend that. This recession in Australia we've seen repeated globally. So although it has been particularly painful here in Australia, we're actually seeing that in a relative sense it's perhaps not as bad as what is occurring in some of the other places around the world. In particular, in Europe, we see in the UK and Spain, GDP fell there by probably more than 20%. The US, more than a 10% contraction. And so what we're actually seeing that there is a bit of a correlation between the COVID medical outcomes and the GDP contraction. So you can see here, those countries with less deaths per capita on average had a smaller GDP falls, while those countries with higher deaths per capita, they generally had larger economic contractions.
Yes, that's clear, isn't it? And what about the forward-looking outlook for the economy off the back of this, Chris?
Well, that's definitely the million-dollar question, Wayne, and it is really difficult to have that outlook. In Australia, we have seen, at least at the national level, that a lot of those restrictions have started to be eased, and we are seeing activity picking up. Now, clearly that's not the case in Victoria, and that's going to be a big drag on the economy in the second half of the year, but at the overall level, things have improved a bit since earlier in the year. Globally, the outlook is very mixed. We're seeing a number of countries that have started to ease restrictions and activity has picked up materially, but we are now seeing some concerns about potential second waves, and we're seeing that particularly in countries in Europe, for example, in Spain, where new cases are actually now higher than they were earlier in the year. So governments face difficult decisions about whether they decide to reintroduce restrictions, whether they're able to do that, and what that will mean going forward. In general, we are seeing in different areas that the economy is starting to adapt to COVID and is still starting to continue to have activity through this time. Industrial production in aggregate is now actually back to sort of pre-COVID levels. But the issue still definitely remains in the services area of the economy. That remains very muted. And some sectors there, such as international tourism, travel, we just think that's unlikely to recover until there is a vaccine. So overall, it still seems that a big snapback in the economy is still some way off, unfortunately.
And turning to the US, a recent big announcement from the US Federal Reserve.
Yes, this gained a lot of publicity. The US Federal Reserve announcing that it will now have an average inflation targeting. Now, this may not sound like particularly big news, but in central bank circles, monetary policy circles, this was viewed as quite a big development. So in effect, what the US Federal Reserve is saying is that they will allow the inflation to run a bit higher than its 2% target. That target will, it will be able to go above that range and below that range, and it will manage around that. Now, again, in many respects, this is not actually that new news. Central banks have been talking about allowing inflation to go moderately higher for some time now. They've been talking about having a symmetry of that target and that their inflation targets are not caps. But for the US Federal Reserve to come out and make the statement that it's going to change its monetary policy strategy, that is a pretty big signal from such a large and important institution. So what are the practical implications of that? As I said, central banks are clearly showing that they're willing and that they're going to be inclined to keep interest rates lower for longer, that they're not going to be particularly concerned if inflation starts to pick up. So in the near term, we still think that there are some deflationary impulses out there, given there is such large spare capacity in the economy. But over the longer term, this slight shift in central bank outlook and policy could mean that there is a potential for inflation pressures to start to increase in the longer term.
And so how have the markets reacted to that news, Chris?
Well, we've seen bond yields rise, so bond returns have been negative in recent period. The market expectation of inflation has continued to increase. So, for example, in Australia, the 10-year inflation expectation got down to around 1% over 10 years. It's now back to around about 2% per annum. So sort of that longer term inflationary expectations have certainly picked up there. In equity markets, we've seen them to continue to rally. So the US and China in particular achieving new highs above pre-COVID levels. And this has been driven a lot by the technology sector and technology-related stocks. So we're seeing stocks like Amazon, Apple, PayPal, Netflix. They've experienced really big rises in stock prices in recent times. We would note, though, just in the last couple of weeks, there has been some weakness, in particularly in those technology stocks, and we have seen a bit of an increase in market volatility. It's uncertain, but this could be related to uncertainty around the future US presidential election, could be ongoing concerns about US-China trade tensions, it may be news on the vaccine developments. There are just a number of potential concerns out there that could cause markets to retrace after such strong gains. The other big area of market movement is the Australian dollar in currency markets. And the Australian dollar we've seen continue to rally. So in recent weeks, it did get up to highs of 74 cents against the US dollar. As you can see, in late March, it got down to as low as 57 cents. So a big move in a relatively short time. One of the key drivers of our currency that's been moving upwards in recent times has been the iron ore price. The iron ore price is up nearly 40% since the start of the year. In some respects, this is quite a positive story. It suggests increased demand from China as it rebounds out of the slowdown earlier in the year from COVID, and as stimulus starts to lead to increased production. In other respects, though, it is still partly or strongly being driven by the Brazilian supply situation for iron ore. So it may not be that those high prices can be sustained, and it may not be then that the Aussie dollar continues to have that upward pressure. But at this point, it is a key upward pressure on the Australian dollar. So overall, there's some positive signs on the economy rebounding, but the outlook remains highly uncertain. And there's clearly some risks out there, and particularly after markets have recovered so significantly, there's the potential that they could retrace.
Great wrap up. Thanks, Chris. Certainly plenty of activity. There'll be more to talk about next month. We hope you can join us then.